Hey everybody, welcome back to the channel, and it's another beautiful Saturday. Well, at least it was absolutely stunning yesterday. Today, well, it's still pretty good. Sun's still out, although it's supposed to snow again a little bit later. But anyway, hey, listen, the spring market is here. The buyers are here and actually coming back in force with that pent-up demand. But what the heck? Where are the sellers? Sellers are really super lagging coming to the market. And that is partly because of interest rates and, why should I trade my 3.5% mortgage for, well, maybe 6.5%? So those are things we're going to go through today. We're going to hit the market update. We're going to talk about mortgage interest rates. Really, at the end of the day, the goal is to get you the best information possible. So when we talk about that, let's talk a little bit about hang on, here we go. All right. The like, share, and subscribe. Really here at the end of the day, you know what? You should only like and share this if you are interested in saving money and making the best business decision. Look, there's no selling here at all. This is just really solid information for you and for people that you know. So share the information, but only if you want them to save money and really make the best decision. Anyway. With that being said, a little bit of a shout out. So one of our team members, Luke, his daughter Kylie was playing basketball yesterday. Went and had the opportunity to watch them there at Lake Washington High School there in Kirkland. And wow, what a great game! They didn't win, but still a really great game. And what an amazing player Kylie is. And I'll tell you, she's right down at PLU right at the moment, interviewing for the President's Award Scholarship, which that's a big deal. So, a shout out to Kylie. Hey, we hope the best for you, and keep playing. It's super awesome. All right, let's get back to the show. All right, so the spring market is here. We're actually seeing some really, really great numbers. Okay, and so when we take a look at it, and we pop over to our next screen here, you can see that our 7-day running average. You can see clearly that we have 769 homes that came on market. Okay, that's the best we have seen this week. Now, granted, this is, the average of the last 7 days. Friday, again, is always a higher number. Friday is a very desirable list date, all right? With that being said, note, we have 1,268 homes that have already gone pending. Now, what's super important about that, since the middle of October, we've actually seen this pattern. So for every home that's coming on market, we're seeing 2.5 homes going off market as pending. And remember, the solds, that's always looking in the rearview mirror, okay? And so remember when we said, hey, yeah, the solds, they're lagging, but our inventory was going off market and our solds were going up. And you are seeing that reflect in the solds as that number keeps creeping up each and every week as we're doing this update. What's important about that? Listen, mortgage rates are the number one thing that is driving activity in the market, especially with buyers, all right? Sure, everybody wants to try and get the best rate. Sure, we actually got it right that in Q1 that we were going to dip down into the fives. Granted, it was brief, and I said it would be brief. It was truly brief. It was 1-2 days tops. However, we are probably not, unless we get some really bad earnings reports, which I'm not expecting that. Inflation is unfortunately heading up still. And so, yes, the Feds are going to be adding another 1/4 to 1/2 point. That's 0.5%, or what they call 50 basis points is my prediction of rate, to the Fed rate, which again doesn't affect, well, it affects long-term mortgage rates. They do not control long-term mortgage rates. Those are look at your 10-year treasury. When the 10-year treasuries are going up, mortgage rates go up. When they go down, the rates go down. When the bonds go up, rates go down. And so you need to watch your mortgage-backed securities, your bond rates, which are not doing very well because we've been getting some really good reports in. All right, that's a given. That's a normal because rates do this every single day. With that being said, take a look at the reduced homes. So we're only at 281, which is good because we're bringing that number down. We're seeing less of that as sellers are acclimating really to what we call our well, really at the end of the day, are really our new market. When we take a look at this, you can see that our graph is doing well. We're technically at 1.8 months of inventory. Now, just a few weeks ago, well, a month ago, we were at 2.3 months of inventory. The only way we go from 2.3 months of inventory down to 1.8 is buyers are pulling down the inventory faster than that glass is filling, okay? And so this is a trend that has been happening, really been seeing a surge since in November, when everybody was like, well, you know, maybe the market, you know, this is going to be a blip. And we kept saying, no, look at what's pending, look at what's coming on. We're seeing some scarcity. Rates were coming down. We were seeing some really, really good numbers as far as interest rates. Sure, they're on their way back up. Completely expected. That's exactly what we said was going to happen. It is. And maybe in Q4, we're going to see that come back down. But they're going to bubble. If we get a bad earnings report, we get a bad CPE report, they'll come back down. But that's going to be temporary. And then they're going to pick back up again. As you can see here, let me get rid of me on this thing so you can see the full chart. There we go. All right. You can see right here that when we take a look at month over month, so February over January, you can see that the pending sales are actually up 36.7% month over month, 40% on sales month over month. Now, we're talking about a small number there, so it makes it look big. Even when we are on the other side, look at the actives. When we take a look at the year to date on the right-hand side, look at that, 112.75. Why is that important? That is super important because remember in October, November, we were at like 228%. And you were like, wow, that's a big number. Okay, yes, but when we were dealing with only 2,800 homes, and then of course we had like 9,000, 11,000 homes that were on market, okay, well, then we start to see something a little bit different as we come down to, guess what? We're into the 6,000s now. So we've dropped half of that inventory since November, December. In fact, 6,739 versus 3,169. So again, another super important thing is we hit into April. I know we have, you know, March to go, which I get, but April, that's when we started to see that significant increase in inventory. Why? Because in 2022, that's when we went from our 4.5% rates, and then all of a sudden we were in the fives, and we were in the high fives, and we were in the sixes, and then we were in the mid sixes, and then all of a sudden, boom, we hit 7, and everything came to a screeching halt. And then it started heading back down again. Activity started to improve. Again, interest rates are the biggest effect on sales in real estate right now. Hope I got that right. Anyway, so with that, let's head back to our illustrious chart here. So when we take a look at new construction, super cool. As you can see, month over month, our solds are off the chart. Again, that is totally expected based on the fact that we're looking in the rearview mirror. When we look at the current year to date, that number of 232%, which shows a pretty significant increase in inventory that has come on market. That's just been lagging inventory that has come into play. Builders have released quite a few more homes, but understand we're pulling that inventory off. So even though normally, historically, November, December, January are historically very slow months, they actually did incredibly well. In fact, the best out of the year when we talk about the higher interest rate months. Now, I'm not talking about the year ago, January, February, because the rates were still at 3%. Albeit, when you look at the chart again, you'll see that last year at this time, we had, year over year, you can see that there was only a couple of hundred homes different as far as homes for sale, and we are still outperforming that by 61%. That's super cool. So when we take a look at bank-owned and REOs, look, super, super low inventory, all right? Sales are down, they say 10%. What is that, 3 homes? So that's peanuts, right? But look at what is pending just for the year to date, 46 over 33. Why is that important? Our inventory is still, as far as REOs and bank-owned, just understand, that's the same thing, okay? Most people just don't understand what real estate or REO, real estate owned, is a bank-owned home. So I put the two together because a number of the lenders that we work with also watch this and they understand it as REOs. So a foreclosure is a process, right? It's like driving, right? You're driving someplace, that's a foreclosure. That is a process. REO is the destination. Well, hopefully not. But even still, the REO inventory, the bank-owned homes that are in our market, super, super, super low. I mean, historically still super low. Even though they're saying that there's an uptick in foreclosure filings, look, there's a lot of things that come into play. And are we seeing that in our area? Not really. Our notice of defaults, which are not published, but notice of trustee sale is published. We can monitor that uptick, and it's a nominal uptick. And remember, 70% of what would normally go to sale is being picked up by investors. And then a very, very small portion of actually making it to the lenders themselves. So if you have any questions, do watch the REO report specifically. But hey, let's head on to the next slide because here we go. When we talk about Zillow's report, the end of the housing market deep freeze. The spring market is back. What's super important about this is the fact that he says the housing market observers could be forgiven for expecting a weak spring home buying season this year. All right. If you watch the channel, you would know and be able to get this very current, up-to-date, in real-time updates. So none of this would be new for you guys. It is awesome that Zillow is coming out with this report. Redfin came out with a very similar report. Fannie and Freddie, they're kind of waffling because, again, most of these guys look at things on a national level. And again, we're very finite. We are very specific to this market and looking at, excuse me, what's going on in only this market, because that's what matters to you. All right. So when we come back here and we take a look at this, so Jeff Tucker at who wrote the article, he says, after buyers began pulling back through the second quarter, prospective sellers also stepped back from the bargaining table. The second half of the year fell 20% from the prior year. The supply slowdown buffered the market from a snowballing price basically in a downward direction. The current low inventory environment is more attributable to the anemic, I love that word, anemic supply, but it will contribute to shifting some negotiation power back into the seller's favor. What does that mean? Hey, listen, that's just supply and demand. There you go. That's a lot of word salad for supply and demand. Look, the sellers, like I said, are not coming back to the table as quick. Sure, we're starting to see some buyers come back. Normally, we should be seeing about 1,200. We have about a little over 700. We still have an enormous amount of pending sales, and the buyers and that pent-up demand is still there, even though we are seeing higher interest rates, meaning that we're starting to tick up. Because remember, we hit 5.8, 5.9. Then we started ticking up, 6%, 6.2. We're up to about 6.5. Some loan programs, actually are below in the high fives, depending on the type of loan balance. So just keep that in mind. If you have questions about that, go revisit. We'll post a link. 5 questions you need to ask when getting quoted rate. Listen, there are some lenders out there right now that are saying, hey, you get a loan through us today and we will refinance you for free. Okay. You guys on this channel are pretty freaking smart to know that that is not 100% true. Nobody is going to tie up all of the resources that it takes to do a mortgage for free. What they will do, however, is they will do what's called a small rebate. They will increase that interest rate just ever so slightly to cover like $2,000, $3,000, $4,000 of cost, okay? Because remember, if you pay a higher interest rate than par pricing, the bank will give you money. Yes, just as much as if you say, hey, I don't want par pricing, I want to pay less than that. So if today's rate is 6% and I want to pay 5.75, you pay for that. You do a buy down versus the other side where if you pay a slightly higher rate, you get what's called a rebate. And that's what they will do. They will tick that up just so that they can say, hey, it's free. It's not free. Nothing is ever free, especially in the lending industry. So don't fall for the trap. All right, just saying. Are there some options to consider? Sure there is. All right, enough said. I'll get off my soapbox. All right, let's head back here. Okay, so when we take a look at the next slide, it says spring 2023 will not be a repeat of 2021 or 2022. Well, of course it's not. We don't have the interest rates, right? Is it going to be the slow and boring market that we said? Yes. Are we going to see in the urban areas between 3 and 4% appreciation? Yes. Did we see an already increase in uptick in the sales price in January by 0.41%? Yes. Is that going to continue? Depends. Depends on interest rates, but we should see 3 to 4% in the urban areas. More rural areas, okay, now that's going to be a bit of a tougher sell. Why? Well, when your fuel costs are up almost 70%, well, it's not quite that high, but your food expenses on average are up 37% on average when we combine everything. That comes into play. And then when you consider the time that it takes for you to travel and everything else, they tend to be less desirable, and people are wanting to move in a little bit closer to mitigate that, okay? Because, well, gas prices, unfortunately, are on their way back up again. All right. Nonetheless, let's keep the show going. All right. So what do we got? We have mortgage rates today at 6.5%. That's according to Freddie. Understand that is your conforming. Now, if you look off to the right on the highlighted section there, it says February 24, 2022. You can see that at that time, right, basically today, it was at 3.89%. Now, today, it's higher, right? Like twice. That is why we're seeing a little bit of pullback from buyers. We're going to see that little bit of dip. But understand, buyers are still out there. Heck, we are looking at a couple of properties. Of the offers that we wrote last week, every one was a multiple offer. Every single one of them. And even the homes that are coming on market today, we're starting to see, yes, a lot more buyers coming out into the market. Are they very, very price sensitive? Absolutely, without a doubt, okay? So making sure as a seller, you are pricing yourself correctly, because if you miss it, you will be sitting on market, and that means less dollars in your pocket. Just saying, statistically, and it's so funny because we had a training meeting, and statistically, we proved through the training and through a couple of videos to clients that if your home sells in the first 7 to 10 days, you'll get between 100 and 107% of list price. Your best opportunity to get the most amount of money in your pocket in the least amount of time with the fewest hassles. Now, you missed that mark. You go out to 20 days. Okay, you're going to look at 98, 96% of list price. You've already lost money in your pocket, out of your pocket, I should say. You miss that mark and you go out to 40 days. You're going to look at 92, 93% of list price. Okay, well, if it's not clear, the more time on market, the less money in your pocket. Price yourself correctly. Absolutely paramount. Buyers are more willing to stretch on a purchase price than they are to meet. In other words, there's a higher desire for gain when there's a sense of loss, meaning competitive offers, other buyers out there, okay? There's a higher desire for gain when there's a sense of loss. Now, if you price yourself too high, you're not going to get a lot of showings, and that's something that is super important for you to keep in mind. All right, I shall get off my soapbox again. All right, moving on. Let's keep this show going. All right, when you take a look at this, Freddie Mac says the economy continues to show strength and interest rates are repricing, that means going up, to account for the stronger than expected growth. But guess what? FHA, they are cutting rates for mortgage insurance. Now, understand, that's super cool because they are dropping it down to 0.55, all right? That's a big deal because it was at 0.85. So realistically, if you have a $467,000 mortgage, it's going to save you about $1,400 a year. in interest. Okay, well, not in interest, but in a fee. All right, now, naturally, you can double that if you have an $800,000 mortgage that goes up to $2,800. That is real money that you get to keep in your pocket. The super cool part is that they're making that happen, but it doesn't happen until after March 20th. Well, March 20th moving forward. So if you're in the process of a mortgage right now with FHA, you don't get this benefit. You almost have to wait. And I don't know if your seller's willing to do that. But understand that could translate into big dollars. All right. Now, the sad part is it is not retroactive. So if you already closed on your loan, it cannot go back. And naturally, this does not work with conventional loans. That's a given. No big deal. But what is the big deal? Okay, remember we talked about the feds and the Fed rate, because what we're looking at right now is a 0.25% to a 0.5%, that's 50 basis points, of an increase between what lenders lend to themselves. All right. It's super interesting that they're showing the Fed officials stated the signs of slowing inflation is not enough to slow that down. I totally agree with that with some of the earnings reports that came in. Expect the Fed rate to go up, potentially go up to 6%. That is not going to be very friendly for mortgage rates, because even though they don't control mortgage rates, they definitely have an effect on mortgage rates. All right, because that's the money that the banks lend to each other, your car loans, your HELOCs and whatnot. So with that being said, if you have any questions, make sure you reach out, make sure you ask, because hey, you know what? Like, share, and subscribe. We love your questions. We answer them typically within about 30 minutes. There's no strings attached. Remember, smash that subscribe button. Make sure you're getting updated when these videos come out. It doesn't matter who you're working with. There's no selling here. The goal is to get you the best information possible. In the meantime, you guys have an absolutely beautiful day. Have a great weekend and stay safe. I will see you on the next video. Take care.